Welcome to all of you who are coming in. We're so excited to have you here. Thank you for joining us. My name is Marcia Butler, and I'm the webinar director here at Advice Chaser. We're so glad to have you. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered, we are not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information here today without consulting a qualified financial professional. We're thrilled to bring you this lunch hour educational presentation on constancy amid change. Attendees are muted, but we encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I want to introduce our moderators today. We are being moderated by some fine folks at Cambridge Financial Services. Eric Piles is one of the principals and founding partners of Cambridge. And our main moderator today will be Brandon Clark. Brandon Clark is a personal financial consultant and director of financial planning at Cambridge Financial Services. He has spent over 20 years in the industry and has the distinction of chartered financial consultant from the American College. Outside of the office, Brandon and his wife, Mary Lee, are the parents of 5 children. He enjoys community and church service as well as fly fishing. And we welcome Brandon as our moderator today. Brandon, I'll turn it over to you to introduce our presenter.
Thank you, Marcia. It's great to be here. Yeah, it's our pleasure to introduce Robert Thomas. Rob is the managing director at Mariner Wealth Advisors. Rob is a chartered financial analyst, a certified financial planner professional, and a certified mutual fund specialist. He's a frequent lecturer on topics such as modern portfolio theory, portfolio management strategies, and fee-based asset management. In addition, he has been published in various financial periodicals, including Financial Planning and the Journal of Accountancy. Rob was named the #3 advisor in Pennsylvania by Barron's in 2020 and the #5 advisor in Pennsylvania by Forbes in 2021. He's also very involved with his community, such as acting as the chairman of the board of St. Joseph's Catholic Academy, and also involved with State College Food Bank and Knights of Columbus. In his free time, he's an avid Penn State and the Pittsburgh Steelers. We are fortunate to have Rob to join us today. We're excited to hear from him and get some of his insights on what is going on with the market. And so we'll turn the time over to you, Rob. And also just a quick housekeeping. If you have questions, just type them in the chat. I will be moderating those, and you type in the questions, I'll ask them, and Rob will be able to address those as we go through the program.
Great. No, thank you, Brandon, and hi and welcome everyone to today's presentation. Thanks so much. And before I get started, and we can get into a little bit more details, I think we need to take a look at our core outlook variables and assumptions that we have and what's going on with the markets and the economy. And so these are some assumptions that we have with regards to where we're positioning our client portfolios. And, we see, new COVID case growth rate, is kind of peaked in early of the year here. We're seeing some stability in that. And right now, no widespread lockdown occurring. We're seeing definitely opening up. We saw yesterday in Texas and Mississippi going 100% open. So that's, again, part of our assumptions that was going to happen, and we're starting to see that. Vaccines are deployed gradually. in the first quarter here, but we see that starting to accelerate. And as the president indicated yesterday, we'll definitely be accelerating in second quarter of 21 through hopefully through ending May and June, that most people have the opportunity to receive the vaccine due. We're seeing the stimulus package right now is we think will be deployed here in first quarter 21. It's in the Senate at this point in time, and going back and forth a little bit, as like any bill, there's 100 things that have nothing to do with the bill. And I think that's what's being debated right now in the Senate. But we see that being getting going and being deployed and out in the beginning of second quarter 21. We see the labor markets in consumption, weaken slightly in that first quarter of 21. A little bit, again, unknown with the vaccine, a little bit unknown what was going on, but it started to rebound now, and we see that rebound in the second quarter with the vaccine deployment accelerating. We see the political transition isn't going to result too much in a hit to business or consumer confidence at this time. It's one of the risks out there, so to speak, that depending upon how the new administration does some things and see how Wall Street reacts to those. But hopefully that it's going to go smooth. The Federal Reserve monetary policy, we expect it to remain accommodative. Their accommodative position there and starting to taper as economic purchases, as economic momentum accelerates. We see short-term rates remain at zero. The Fed president came out and said, hey, we're not doing anything with interest rates on our piece now in regards to the short term. But we do see the yield curve steepen. We saw that what happened the last couple of weeks. We saw that volatility in the marketplace there. We think that's it has, and we expected it to sort of calm down. And so we see it steepening, but we don't see it continuing to go, crazy like it did here the last few weeks. That kind of subsided, and we believe it will. And again, macro output returns to pre-pandemic levels, and we expect in the fall of 2021, as this, no more lockdowns, the vaccine kicks in, more and more states open up, we'll see that market, start to come back with regards to those certain sectors. Let's talk a little bit about it in the weeds here in regards to economic comparable and drivers. Why, you saw that first slide, optimistic of things that's going to happen. We're optimistic on the market. And you see in real GDP growth, and real means is GDP minus inflation. So we see, in 19, it was 2.2, 2020 last year, it actually ended up with minus 3.5, crazy swings. If you remember, minus 30, plus 30, but it ended up minus 3.5. We expect 2021 to be about 4.5 real. So we'll see about 6, 6.5 given inflation GDP. And again, that momentum is, a plus 8%. Consumer spending, we're seeing that as well, continuing a negative in 2020, up to a 5% in 2021, which is nice. Residential investment, again, kind of flat in 19, 2020, a little bit, people staying home, doing some more, but we see that rebounding nicely in 2021. And then capital spending was again negative last year, but we see that coming back as positive. So, from that, those momentum, we can go to the next slide, is the growth. So when we look at GDP is what, as investors, we're looking at what? The stock market. What are the earnings of these companies that we're investing in? And going back to years that had a real growth rate of GDP of 4.5% plus, and you can see 62, 64, it goes through. The most recent one, it was 1999, which had a GDP above 4.5%. So it's been a while that we've seen it. And so you see these earnings gains are pretty nice when you do have this positive GDP. And so we're expecting that again. We don't know what's going to happen here in 2021, but historical average is about 15% earnings gain. I'll talk about it a little bit later, but we're seeing closer to 20% earnings gains for 2021.
Hey, Rob, real quick, one question came in that others may be interested in, the question of whether or not people will be receiving these slides. You will be emailed a replay of this broadcast that you'll be coming to your email address.
Perfect. Yes, this is being recorded.
Thanks.
Perfect. Next slide. So we see this this economic momentum and not just growth. We're seeing this shift in GDP growth, in earnings growth, and take a look historically. Want to say, hey, what's happening with the S&P 500 price change? And so you see, we're not sure what's going on in 2021, but we have this nice 8% growth change that I mentioned there on the second slide, that momentum that I talked about. But historically, you see pretty good of 3% plus presented some very nice S&P 500 returns for that year. So we see in 2021, we expect, again, that positive GDP, real GDP, 4.5% plus. The momentum is going to be, that results in a momentum of 8%. And so if history somewhat repeats itself, we should see a nice earnings growth, and we should see a nice S&P 500 positive returns. That's our expectation and hope. So let's take a look at, what we're looking at, our outlook and positioning in 2021. So I gave you that background of where we're coming from with earnings, with GDP, what's happened with the momentum, and historically what's happened. So right now, we expect, again, the pandemic to end with the distribution and application of the vaccine to reach 40+% of the population, come May, and then finishing up is whoever wants to get it by end of summer. Again, that real GDP growth of about 4.5%. And we see inflation to rise slightly to 2%. So I'm not saying it's going to go to 2% and stay there. It's going to grind out a little bit as time goes on throughout the year. And we'll see at the end of the year about 2%. So we're saying average around that 1.5 to 2. Unemployment to fall by the end of the year, but still stay above the levels we saw in early 2020, just because I think that, the world's changed a little bit with regards to unemployment and people staying at home, then, as we are today, Zooming, and people in the office, and some changes there. We don't see that unemployment coming back as fast as the economy at this time. Corporate profits, I mentioned, we expect 20% plus those earnings that I mentioned before. And so GDP of 4.5 results in a corporate profit of 20 plus. Again, we saw on the chart historically, that was some good returns for the S&P 500. Longer term capital demands rise as number of service related businesses attempt to reopen. As we see states reopening, we see restaurants and airlines and travel and going to see grandma. That's all going to require long-term capital demands that businesses are going to have to meet those needs of the consumer when the things open up. As I mentioned before, we expect the yield curve to steepen. When I say that, it means that the longer term part of the interest rates will start to increase. There's some, seeing what's going on with the markets on that. And that's kind of expected. And you kind of see that if you're going to see a GDP growth of 4.5, which is fantastic. That's real GDP, and corporate profits. We expect rates to go up a little bit. And so there's nothing that we're worried about at this point in time. But we do see the value of the US dollar gradually decline to many foreign currencies. And again, that's not a bad thing in this period, given the GDP and the corporate earnings that we're going to see. So I take a look at the fundamentals, valuation, and technicals. And we always want to take a look at this, but they're still positive. We're neutral on IPOs. We're a little bit neutral on a PE ratio. We're seeing the PE ratio right now of the S&P is about 27. Historically, it's around 19, the last 10-year average. We see a little bit better valuations in small cap and international. We'll talk about that a little bit too, that transition to those asset classes, but we're still neutral on it. Price to sales as well. And we see a little bit neutral in sentiment. Just, people still unsure what's going on in the world. And so we see that. But everything else, we're we're positive on. And as you notice, we don't see any red negative signs at this point in time. And that I think goes in line with what we're expecting with regards to GDP and the corporate earnings.
Hey, Rob, we got a new question that came in with regards to cryptocurrencies. Obviously, there's a lot of activity going on with that, a lot of publicity about that. Do you feel that it is reasonable to add cryptocurrencies to one's portfolio? And if so, how do they access how does one access which of these crypto stocks are the right ones to invest in?
Yeah, so with cryptocurrencies, it's, kind of crazy out there. I guess if you bought, $5 worth of Bitcoin back in the very beginning, you're worth 470 million or something like that, which is pretty cool. But, we're not recommending it. There's still so many unknowns. And again, this is an unregulated, you can't even call it an asset. It's the SEC doesn't consider it an asset. Technically it's, when you do assets under management firms, they can't include cryptocurrencies as part of that calculation. And also, again, there's no oversight to it. Also taxes, in regards to the taxation of these. I give you Bitcoin, I have this Bitcoin that's gone up in value and I give it to somebody. Well, who's paying the tax on that? A lot of times there's no taxes. So there's a lot of what ifs out there. We don't recommend it. You have a few options to do it. We do offer it at Mariner by client request. We can get it. You can buy it through the blockchain, so to speak, directly, but there's a lot of disadvantages with that, especially fees, safety. There's some ETFs out there now that you can get exposure to it, or you can buy it direct through certain custodians that have now opened it up to be able to purchase cryptocurrencies. We're not, again, recommending it, but if someone wants a client to take a position, I'd look at no more than 5% of any liquid assets.
Thank you.
Yep. You can go to the next slide here. And so, we talked about GDP, we talked about corporate earnings, we talked about being optimistic. So what does that relate to return probabilities for 2021? We're looking at down below, look, optimistic case, base case, disappointing, pessimistic. Some of those things that we talked about don't hit. But we see that, we're 75% probable that we expect, you can go back, 75% go back, that we're seeing a return of 6 to 13% in the S&P 500 for the year. I'm optimistic that it's going to be more closer to the 13, just personally. But that's the range that we're seeing right now. Currently, right now, year to date, the S&P is up around 1.7, give or take. But we are seeing some nice surprises in like the small cap. Russell 2000 is up over 11%. So those are some nice returns there. So again, given a transition now, historically, you saw on some of those charts that the S&P 500 actually did better than what I'm saying here. We're just taking into consideration that, hey, there's some slowdown in the vaccine. There's a lot of what ifs there, so to speak, with some bricks in the wall worry. You may have heard that phrase before, that we're pulling it back a little bit, expectations of what historically may have happened when there was not a pandemic and people had to get vaccines and all the travel restrictions. There's a lot of differences in those previous years that we're taking into consideration here and being a little bit lower on our expectations. Okay. So I just mentioned the current wall of worry items. And so, what investors worry about in the headlines? We're seeing the vaccine. We just talked about execution risk, mutated strains. Is that going to cause another shutdown, keep schools from opening? All those variables that we hear in the news all the time. Fiscal policy, bobbles. I mentioned, hey, the Fed's not raising rates and, the administration's going smooth. But what happens if we have some transition issues and some of that fiscal policy doesn't go as smooth as we anticipated? Is definitely, what we're seeing worrying in the headlines. And then, regulatory risks. There's the FTC and the DOJ investigations and everything going on. So what do we worry about? What do I worry about as an advisor, as an analyst? I'm worried about economic growth. I've been talking about that for the last 15 minutes here. Employment, earnings, interest rates, and the credit spreads. As that steepening of that yield curve. So that's what we worry about. That's what we're watching closely. We see that we're optimistic, we're positive, but again, there's some worries in the headlines there that we have to keep an eye on. And then throw some wild cards. It's just geopolitical risk. It's still, Russia, China, Iran, still, with regards to some geopolitical risks. And then you're starting to hear a little bit more about inflation. We said expect that inflation is going to increase. Well, you just can't have a GDP, an opening economy, and then prices staying the same. So that's where we are now with regards to inflation, keeping an eye on it. Excuse me. Does the market look toppy? When I mean toppy is that 9 factors that we look for to generally signal a bull market top. We're positive that we don't have any at this point in time. IPO activity is a caution, but it's never really been a best predictor of bull market tops. The blow off top, the heavy inflow into equity market funds, big pickup in M&A activity, rising real interest rates, weakening upward revisions. We're not seeing any of this. So we're still seeing a positive check mark on these factors that generally historically has said, hey, we're not signaling a top of this bull market. So something we want to keep an eye on, and we continue to watch it very closely. But right now, we don't see those signals. This is kind of difficult to read there, but, we're talking about the markets and the worries and everything going on, but, I'm a firm believer in diversification. And it's the element of asset classes. Remember back in science, the element charts and, sodium, Na and all the good stuff there and all that good stuff. But what this is showing is the returns of the various asset classes from different years, going back to 2006, looking at the averages of the highest to lowest. And you see all the different colors. It's crazy. And that's the idea. It's, things go great and then they drop to the bottom. Things go not so hot and then they jump to the top. But you see there, I have the black line collecting is a diversified, just a simple diversified 60-40 portfolio. Look at the consistency there. Very consistent for clients. I'm not saying 60-40 is the right, please, I'm not recommending that to you individually. I'm not recommending any asset allocation to you without knowing your individual circumstances. But in general, a 60-40 is a sample here. You can see the consistency of the returns of being a diversified investor. I think it's always a good reminder to us as investors to take a look at that, keep an eye on it, and see like, hey, I'm not taking bets. The idea of investing is what? To create wealth. Putting it all into something crazy and going up and then watching it drop is not creating wealth. Creating wealth is that consistency of compounding returns in our client portfolios.
Rob, I've got another question here.
Yep.
That is, do you see any major future industries changing or evolving, such as 5G or the electronic vehicle markets? And then the follow-up question is, how does one anticipate these investment opportunities to align with new technologies that are growing year after year? Yeah,
it's a good question, and it's interesting because we're seeing right now what in today's market year to day here, what's going on. These technology stocks are getting beat up pretty nicely here. Again today, we see the Dow up and the what's going on with the tech stocks. You see Amazon, the Microsoft, and Apple again down today. The Nasdaq down today. We like those communication service stocks, and the financials and energy are our 3 top sectors. And you see such as it was mentioned in the question about 5G. So we like those communication services and those stocks that relate to those in our client portfolio. So we definitely are looking at those you know, sectors in the portfolio, and communication services is definitely one of them on that. But like I said, technology we're neutral on, but we're seeing a pullback from those technology stocks at this time. We don't expect it to continue forever, but we're seeing more of a transition. We're seeing some good old, we did it, selling at a high, buying at a low in some of these asset classes and investments. How long do you wait till it go up, till it drops? It's always good to, again, as investors, we want to make money, so sell high, buy low, and so you have to follow that policy personally and through your professional advisor, and so keep that in mind as well.
Thank you.
So where to invest? To give you an idea, I've been talking about what we're doing, how we're doing, what we're concerned about, but here we are. We just large cap, looking at the equity position, we were 72% large cap, 15% small mid, and 13% international in our diversification asset class. But we took some of those gains I just mentioned in the large cap area. We did this in early January. We did it after the first of the year because of taxes for non-qualified accounts. But we dropped that to 60% in large cap. So we're definitely still overweighted. But we then increased small mid cap to 20 and international to 20. So the small mid cap has done very nicely for us. And we continue to see, again, some solid returns in those that asset classes at this point in time. So like I was mentioned before, S&P is up about 1.7. Russell 2000, the small cap, is up about 11.5, and EFI is up a little bit over 1. So right now we're seeing that, but that's our weightings, and that's going back a little bit to the question before, is that we took those gains in the large cap area. And again, growth versus value. You hear that terminology a lot. Growth stocks versus value stocks, and growth assets classes and value asset classes. We were considerably overweighted in large cap growth, which was a great. And again, we took some of those profits there at the beginning of the year, and more of a 50-50 versus growth versus value. So growth, is your healthcare, technology, consumer discretionary stocks, versus your value stocks of financials, energy, communications, those types of ones. We sort of balanced that out. And our fixed income, we're intermediate right now, in 20% into multi-sector high yield to pick up some interest rates there. We're targeting that intermediate term duration for our bond portfolios. We eliminated government bonds and we had them in there last year because the craziness, who knows what was going on, remember, and end of February, March, April, beginning of May, world was kind of crazy. Things were going not so well with the stock market. We added some government bonds in there just for some hedge and stability and safety in our client portfolios. But as you see from our conversation today, that we think that's kind of over at this point in time. And so we eliminated the government bonds. We're focusing on domestic high credit quality issues. But again, we put 20% into multi-sector, diversified income, high yield bonds, and we just talked today at our investment committee. We might be increasing that percentage, given, as I mentioned before, the steepening of the yield curve and what we're seeing with regards to credit spreads.
Rob, on that, a question that we get a lot when we meet with our clients, especially those that have been a little younger, trying to figure out why they should put anything in bonds, given how well the equity markets have been doing and for so long. Why invest in bonds at this stage, especially if you're younger?
Yeah, it's a question we get all the time, and the answer is you're never going to get rich off bonds, and you're never going to retire early off bonds unless you're some crazy bond trader. But other than that, bonds are strictly in the portfolio to help with the risk of the portfolio, to put a floor in your portfolio as a hedge against equities. Historically, bonds go up in value when stock markets take a big hit. And so as you're younger, you may have less in those bonds because you have more time to recoup losses. You're more aggressive. I'm 30. I'm not going to be retiring for another 30 years. I don't care about the stock market. I'm just going to keep investing in it. That's great, but also keep back. Don't, historically, if you look at a portfolio, it's 100% stock. Just by adding 5 or 10% bonds, historically, those have done better in return. Because if you invest 100% stocks, you go up with stocks, you go down. You go up, you go down. The idea, as I mentioned before, the idea is to create wealth, not to get the highest return one year and see it go away the next year. And so by adding those small amount of bonds, you create a little bit of a hedge to actually help with the risk and return of the portfolio. And actually, historically, that's equaled to higher percentage gains for you as an investor. So definitely, even if you're the most aggressive client, look at adding some bonds in the portfolio. It will pay off at the end when you see some of that crazy volatility that we've experienced in the past.
Thank you.
Yep. And I always like showing this slide. It's a good, reminder, so to speak. And, we get clients come in and say, hey, should I invest this cash today, or should I wait? Should I do this? I think I'm going to sell and get out of the market now, and I'll wait till things calm down. But historically, that's been the wrong way of going. And we encourage staying invested. Trying to time the market is difficult. If you can, please send me your resume. Without a doubt, we'll hire you, because market lows often result in emotional decision making. Investing for the long term while managing volatility can result in a better retirement outcome. And so you see here from the chart, just going back since 95, a good 25 years. It's the same chart applies no matter really what time frame you look at. But going back 25 years, if you're fully invested, you average 7.8. If you missed the best 50 days, you dropped all the way down to minus 2.5. You average. This is average annual growth rate, not the total return, but year after year. And again, even if you missed the best 20 days because you were out of the market because you weren't sure what's going on, things are crazy, you only average 2.4% in the S&P 500. So again, just a good reminder, again, not looking at individual circumstances. And again, individual circumstances, best. And with your advisor, this is not advice, but just keep in mind historically what's happened when you're out of the market. So let me finish up here a little bit, and current focus for clients, but current focus for you. Don't vary from your risk profile. Maintain your risk profile. I always tell clients, don't hop on the crazy roller coaster ride if you don't like it. Just stay on the one that you like. And that coming from a guy who doesn't like the crazy ones, but maintain that risk profile. And use the current market environment as an opportunity to rebalance accounts. Remember, I mentioned before: sell high, buy low. Structure your portfolios. Take advantage of the market upturn. Take advantage of market downturns, depending upon, again, your individual circumstances, time horizon, income needs, tax situation. All those have to be looked at, and consult your financial advisor. But again, don't hesitate to use the current market environment or any market environment as an opportunity. And again, I demonstrated some optimism here in regards to what's going on with the GDP and earnings and S&P 500 and returns and the world in general. But don't forget to keep volatility in mind. And that question before on the bonds applies exactly to this: is you want to make sure that your portfolio is positioned to withstand some blows in case it does. But you saw that chart, that asset element chart that I showed before. You saw the consistency of that asset allocation diversified portfolio. And that's what happens when you keep volatility in mind. You have those consistency in returns. So I know that we definitely have time for more questions and answers, but thank you very much for listening.
Thank you, Rob. We don't have any questions pending right now, unless there's someone want to ask questions before we close up. But we appreciate you joining us. Again,
Brandon?
yeah.
Oh, sorry. We were talking before the webinar a little bit about some of the questions you had about what sectors Rob sees as kind of up and coming. Maybe we could go over that. That was very interesting.
That's fine. Yeah, the question came up before. We were just talking about the difference between growth and value stocks. Last year, value stocks got hammered pretty heavily, and so the question was, what role does value play, or what is the forecast for value, and how are they fitting into portfolios moving forward?
Yeah, it is a good question, and without a doubt, we saw a huge discrepancy between growth and value last year. Again, remember, for participants that are listening, growth stocks are more your technology, healthcare, consumer discretionary, those ones that are growing, and the reason they're going up in price is the growth in their earnings. Where value stocks tend to be a little bit more, hey, I think these stocks are good price, they're paying a good dividend, and so you see a difference in returns of these different asset classes in industries because of this value versus growth. So last year, growth killed it. You saw, if you follow the markets at all, you saw, what happened with Amazon and Apple and Microsoft and, just huge Netflix and Facebook, just huge returns that drove the markets. If you took those stocks out of the S&P 500, those 10 stocks, the returns weren't that great for the S&P 500. So those growth stocks really did well. We're starting to see a transition already this year to date. We're seeing large value outperforming large growth by over 6%, and small values outperforming large growth by almost 16% just year to date. So we're starting to see that transition a little bit. Again, as I mentioned before, we did reduce our large cap exposure and went to 50-50 growth versus value. And why you're seeing that is because you're seeing great traditional value stocks of financials, energy, and communication services are doing very well year to date as compared to the rest of the market. Consumer stocks aren't doing so hot. Technology is flat. So again, we're seeing those asset classes transitioning, and we're seeing that right now.
Another question that be curious on, obviously there's been a lot of press around things like the whole deal with GameStop. There's certainly some speculation that's going on, and a lot of people wanting to make a quick buck. At what point do you guys determine, when do you invest in a Tesla? When do you invest in a GameStop, if ever, outside of normal parameters? How do you, as a wealth manager, as an analyst, determine at what point do we take a company or a sector or an industry serious from an investment standpoint?
Yeah, so definitely missed the GameStop stock run up there, and stayed away from it. That was pretty crazy with regards to what was going on and what happened there, and stopping trading and everything else. That was pretty crazy. And so, we don't go chasing those stocks. We're just not. That's not the way we manage money. Some stocks that we've made some awesome returns for our clients, and say Amazon and Apple and Microsoft that we have in our stock portfolio, and some basic name too, ones that are some of those pharmaceutical stocks, and good old plain old Home Depot. We've had some very, very nice returns. They don't get talked about too much because everybody hears about it. But we do, like you mentioned about like the sector, and kind of what we're doing a little bit now in regards to increasing our value stocks, picking up those value asset classes, and reducing our technology and consumer staples. We reduced those. We just sold a couple stocks out of the consumer staples in our portfolio. So those changes we're always making and adjusting for our client portfolios, but we're not chasing those ones. And like Tesla's a good example too. It's gone up. It's come down, but it's a tough stock. Not much earnings there. There's a lot of question marks with it, and so we'd be happy with, hey, I think we're going to hit a lot more doubles and triples with some of the stocks we do than trying to hit a home run. I remember Babe Ruth struck out more than he was the biggest strikeout leader in baseball. And so we kind of follow that a little bit too, that if we're hitting, doubles and triples in our stocks, we're gonna make money.
Very good. Thank you for that. Well, that's the end of the questions. Again, we appreciate you joining with us. As we mentioned in the beginning, so I'm the Director of Planning Services at Cambridge Financial. Cambridge Financial Services is located in Chandler, Arizona. We're a financial consulting and strategic planning firm specializing in comprehensive financial advice and wealth management. And we partner with Mariner, who manages a great deal of the wealth for our clients. So it's been a pleasure to sponsor this presentation today. If you have questions, you certainly are welcome to reach out to any of us. And again, we thank you for joining us. Rob, again, thank you for your time and expertise. And we look forward to the next one.
And on behalf of Advice Chaser, I want to thank our moderators and our speaker today. Thank you so much that's worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event. You're welcome to share that replay with family and friends. And here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce you to. Find out more by going to advicechaser.com and click on the link to find an advisor. Once again, for Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye.